All right, let's get right into it. The year is 2026, and you can just feel the tension in the market. So, to figure out what's coming, we're going to turn to the one guy who's pretty much seen it all, Warren Buffett. We're going to break down his classic wisdom and see how it applies to the crazy world we're in today. Right now, investors are staring down a perfect storm. You've got stocks that feel incredibly expensive, an absolute mania around artificial intelligence, pushing some prices into the stratosphere, and a global economy that's looking a little shaky. It's a lot to wrap your head around.
So, that leads us to the big question, right? In a market that's just swinging between hype and fear, what does Warren Buffett actually do? How does he manage to tune out all that noise? Let's unpack his game plan.
Okay, first up, the AI bubble. Look, it's not exactly a secret that this feels a whole lot like a tech bubble 2.0. But for Buffett, this kind of crazy market behavior isn't just a risk, it's something else entirely.
This chart really tells the whole story. I mean, look at this. A tiny handful of companies, what we call the Magnificent Seven, are responsible for a mind-boggling 3/4 of the S&P 500's entire return since late 2022. This is not a healthy, broad market rally. No, this is an incredibly narrow one, where almost everything is riding on the hype around AI.
And here's Buffett himself, just cutting right through all that excitement. He points out a really simple truth. With all the billions pouring in, nobody, and I mean nobody, really knows which companies are going to be the long-term winners or even what the best uses for AI will be. It's all just one giant bet on a future that is completely unknown.
You know, we've seen this movie before. Back in 1999, people were throwing money at any company that had .com in its name, all based on the promise of the internet. Today, they're doing the exact same thing with AI. The technology is different, sure, but the human behavior, that speculative fever, it's identical. And this is the key. Back in 1999, at the absolute peak of the .com bubble, Buffett wrote that the real goal isn't trying to guess which new tech will change the world. The goal is to find a company that has a real, durable, competitive advantage, a moat. It's always about the quality of the business, not the promise of the technology. And here's the punchline. For Buffett, all this AI frenzy, all this speculation, that's not something to be afraid of. He sees it as the very thing that creates future opportunities. See, when everyone else gets caught up in a mania, they do dumb things. They make mistakes. And those mistakes, they create bargains for investors who are patient enough to wait.
So that brings us to his current strategy. People have made a huge deal about Berkshire Hathaway's massive cash pile. But what is that pile of money really telling us?
If you want to understand why Buffett is sitting on so much cash, just look at this chart. It uses a metric called the CAPE ratio to measure market valuation. The long-term historical average is about 17, and today it's at 40. I mean, we are at a level of overvaluation that we have only seen one other time in modern history, and that was right at the peak of the 1999 tech bubble.
But here's the thing. This high valuation isn't everywhere. While the big S&P 500 companies, the ones fueled by AI, are up around 80% in the last 5 years, the Russell 2000 index of smaller companies, well, it's a completely different story. It's nearly flat over that same time. That huge gap shows you that the frenzy is really just happening at the very top. For someone like Buffett, the real opportunities might be hiding in the parts of the market that everyone else is ignoring.
Which brings us to this absolutely staggering number, $377 billion. That is Berkshire Hathaway's war chest. It's an all-time record, and it's a massive signal about what Buffett is thinking right now. So naturally, when you see a number like that, you ask the obvious question. Is the Oracle of Omaha predicting a huge market crash is right around the corner? Is he trying to time the market? And the answer is, well, not exactly.
The real reason is actually a lot more disciplined. First off, he's selling when things get expensive. He trimmed his massive Apple position after its valuation more than doubled. Simple. Second, with prices this high across the board, he's just not finding many good ideas. In his words, prices are sky high. And third, he's just being patient. He famously says, we only swing at pitches we like. So that cash pile isn't a prediction, it's just a byproduct of his discipline.
So what's the big takeaway for you in all of this? Let's try to boil these ideas down into a mindset you can actually use, and learn how to turn the very volatility that scares most people into your biggest advantage.
First, let's be real clear. Buffett is not blowing smoke about the risks. He has flat out warned that future downturns could be more intense, a hair curler, as he put it, than anything we've ever seen.
He knows that big mistakes can and do happen.
But right after that scary warning, he gives you the antidote. His rules for surviving it are so simple, but they're incredibly powerful. You got to check your emotions. You have to develop the right temperament so you don't panic during big swings. You need to commit to being a net buyer of good businesses over your entire life. And you have to remember that in the long run, great businesses and America, they always come back. That's the mindset that turns fear into opportunity.
And if you need any proof that this works, just look at his own company. Berkshire Hathaway's stock has been cut in half 3 separate times. 50% drops. And yet every single time, because the underlying businesses were strong, the stock eventually recovered and soared to new highs. This isn't just theory for him, it's what he's lived through.
So, we'll end on this thought. We've seen that the market is constantly pushed and pulled by fear and greed. We've seen that the AI frenzy today looks an awful lot like the dot-com bubble from yesterday. So in a world like that, where everyone is chasing the hot new thing, could it be that the single greatest competitive advantage an investor can possibly have is just patience?